Legendary investor Jim Rogers is very concerned about today's vastly over-leveraged economy and grossly distorted financial markets. An astute scholar of history, Jim, who's nearly 80 years old, predicts we are headed for the worst downturn in his lifetime. Why? And what should today's concerned investors do to protect their wealth from it? Keep watching this video to find out. And as always, please take a second and click the like button below to help us continue the run of amazing guests like Jim that we've been having on this program. The more likes these videos get, the more big names we're able to attract. And now, let's get started watching this week's market update featuring legendary investor Jim Rogers. Hello folks, Adam Taggart, co-founder of peakprosperity.com, welcoming you back for another week of trying to make sense of these markets. We've had a lot of great guests on this program. Today's guest is perhaps the best of the bunch so far. We have the legendary Jim Rogers. He is an author, financial commentator, and very successful international investor. You've probably seen him either on Times, the Washington Post, New York Times, Barron's, Forbes, Fortune, Wall Street Journal. He's done it all. And he's also been a visiting professor at Columbia University. But what's great about Jim is he really gives back. So he was very successful in his early career. After going to Yale and Oxford, he was no slouch intellectually. He then co-founded the Quantum Fund, which during its first 10 years posted a return of over 4,000% at a time where the S&P barely managed to do around 50%. So definitely a smart cookie. He then retired. He took a motorcycle, biked around the world, got himself in the Guinness Book of World Records in the progress, and now basically shares his perspective and wisdom with curious-minded investors from around the world. We're incredibly lucky that he was able to join us today from Singapore, no less. It's very late his time. Jim, thank you so much for making the time to join us.
Well, Adam, I'm delighted to be here. You know, I still have time to talk to you, then I can get to the disco.
Right. Gosh, if I accomplish a quarter of what you do in your life, Jim, I'm going to consider myself an extremely lucky man. So I want to start this interview the way that I start them all, which is by not introducing any of my biases first, positively or negative. I just want to ask you, Jim, what is your view of the state of today's financial markets and the global economy?
Well, Adam, I'm sure you know, if you look out the window, you see printing presses everywhere. Nearly every central bank and every government is spending and borrowing and printing as much money as they can. Markets love it. I'm not sure what the world is going to think about it in a few years. Somebody's, you know, Adam, it's good to be old. Young people have a very bleak future ahead of them. I got a couple of young kids. Oh my gosh, someday people are going to wake up and say, wait a minute, where did all this debt come from? Now what do we do? Oh, it's going to be bleak. You know what happened to all the other countries in history that have gotten themselves deep into debt? Hasn't been pretty.
All right. So I had asked that question because I had done some reading, Jim, and you had made this following quote, I think last week. The next time we have a bear market or an economic problem, it's going to be the worst in my lifetime. I was born in 1942. So the next time we have a problem, it's going to be the worst you've ever seen, certainly worse than the Depression. Now, that's consistent with the statements that you just made. I guess my question is how do you expect this to manifest? Where are the weakest points in the system? And where do you see the worst of the pain being experienced?
Well, Adam, the Depression ended in 1942 when I was born. So I don't know if it's going to be, the next one's going to be worse than the Depression, but it's certainly going to be the worst in my lifetime. And the financial markets, as I said before, with all this money printing, markets I think it's just wonderful. Adam, give me trillions and trillions of dollars and I will show you a very, very good time. It's wonderful. I don't know about my kids or your kids or anything else, but it's not going to be good down the road because, yes, lots of money being printed and spent. Markets are going up. Markets love it. It looks like we may be entering a blow-off period, especially if we enter a blow-off period. Then when the next collapse comes, it is going to be very, very bad. In 2008, we had a problem because of too much debt. Well, since then, Adam, the debt everywhere skyrocketed. Even in China. China didn't have any debt 20 years ago. Now even China's got a lot of debt. So I don't know who's going to bail us out next time around. Probably nobody. And maybe even the money printers will run out of trees. They're going to have to print so much. So I worry when the next bear market comes, it's got to be worse than 2008 because the debt is much, much, much higher than in 2008. Now, unless you know some miracle that's going to do something about the debt, it's got to be worse.
Yeah, I sure wish I did. So it seems like the huge question then, Jim, is regarding the debt is, it's that classic, inflation versus deflationary outcome, right? And I'm curious if you see a higher probability on one side or the other. Do we collapse under these debts and we have huge debt defaults that ripple through the system and bring it down? And of course, that's very deflationary. Or you mentioned earlier that the central banks are now just printing trillions willy-nilly. Do the debts remain, but they just get, inflated away basically because we've killed the currencies? Do you have a...
Well, at the moment, there's no demand everywhere. So we're having deflation, or certainly not inflation, with airports empty, et cetera, et cetera. The price of gasoline is down, price of everything is down because there's no demand. But eventually, throughout history, when you print huge amounts of money, Adam, history is pretty clear. It has always eventually led to higher inflation when you print too much money. When demand comes back, it leads to inflation. It always had. Now, maybe it won't this time. Maybe somebody's coming, Janet Yellen says, don't worry, we've solved all the problems. We won't have a bear market again. She got a PhD from an Ivy League university. So if you believe her, then things are going to be great. But my reading of history is they either going to default or print it away, deflate it, inflate it away, make the paper money worthless. There is a new theory around at the moment, and whenever there are problems, anybody who's got a theory, if it sounds reasonable, people start to use it. Remember Mr. Marx? Mr. Marx had a great theory. There are a lot of people, it was a wonderful theory, and it sounded great for a long time, and a lot of people used it. Nobody believes in Marxism anymore. We figured out it was useless, but my goodness, a lot of people fell for it a long time. There's a new one now called MMT, More Money Today, and everybody wants more money today. You know that, and it sounds great, and maybe they're going to try it and fall for it and use it, which just means more and more. It debases the currency one way or the other, and you better own some assets that will maintain their value. Whether they just continue to print it or it's MMT or borrow it and spend it, whatever, this has always eventually led to higher inflation.
All right. Well, I want to tug on that thread for a little bit because at different points in the past, you have, I think, made some very good calls in the commodity space, which is basically, encouraged people to invest in hard assets. And if you're talking about a future where the risk of inflation and high, maybe someday even hyperinflation, could be possible. One might presume that hard assets would be a good place to park capital if you're concerned about trying to preserve the purchasing protection of the purchasing power of your wealth. Do you still feel the same way?
Well, this is not an opinion. This is a historic fact. Whenever currencies get debased, hard assets protect you. That's not an opinion. That's a simple fact. And yes, I expect that to happen again. For instance, I bought gold all my life, or nearly all my life, but I stopped in 2010. Didn't sell any. But in summer of 2019, I started buying gold and silver again. Not buying it today at the moment because of the correction, but I expect to buy a lot more gold and silver, because historically, that has been a way to protect yourself and sometimes even to make a lot of money if you get the timing right. As you know, Adam, professors and media types say, don't bother with gold, it's a barbarous relic, etc. It may be, but all of us peasants know that when things go wrong, we want to own some gold and we want to own some silver. I'm just another old peasant like all the rest of them. I'm going to buy more gold and silver, and I know that will protect me eventually and my children, and probably other real assets as well.
Great. And we on this program have mentioned many times in past months, we share your outlook on gold and silver, Jim. We've definitely been advising people to certainly add it to their portfolios if they don't have it, or to be increasing over time. You mentioned other real assets. I'm just curious, are there any other ones that you think are worthy of considering at this point in time, whether agricultural or real estate, or I'm
At
just
the
curious if any
moment,
have caught your eye?
I have been buying agriculture, not in a month or so, but yes, no, I've added to my agriculture. Agriculture is a disaster, Adam. You know, more people in America study public relations than study agriculture. The average age of farmers in America is 58. In Japan, it's 66. I can go on and on. The highest rate of suicide in the UK is in agriculture. I mean, it's a terrible place to be, has been. But as you know, anything that's been in a long depressed market for a while, when it turns around, somebody makes a lot of money. And back to the Lamborghini drivers, they're going to make a lot of money.
All right, all right.
When I say Lamborghini drivers, I'm talking about the farmers eventually are going to have Lamborghinis.
Right, right. And just for context for folks, before we started the program, we were talking, and the folks from New Harbor who will come on in a bit, we're talking with Jim about how their farmers actually drive sports cars. All right, so
They actually drive Ferraris in Massachusetts.
yeah, exactly. I just wanted to point out, Jim, I'm going to put up a slide here. But it shows that commodities valued relative to financial assets are at like a several century low right now. And so it does seem to, giving additional firepower to the wisdom of at least putting some in your portfolio here. But of course, that's from a speculative gain standpoint. Of course, we're talking about the wisdom of buying some just to hold the preserve the purchasing power of your wealth. So it seems like many reasons to own them. So where I want to go next, Jim, is just you've got two daughters. You just mentioned them a few minutes ago.
Let me just finish one.
Yeah.
I just had a thought.
Sure.
You know, silver's down 60% from its all-time high, 60%. Microsoft is not down 60% from its all-time high. You don't know much that's down 60%. Sugar is down 80% from its all-time high. I mean, Adam, in the I hate to use the word commodity because it's a loaded term, but in the real asset world, there are things that are down enormously, when things like Apple go up every day. Bonds, you talk about a bubble, bonds in a serious bubble. Interest rates have never been this low in recorded history, never. So we got some bubbles out there, and we also have some depressed assets. As I look around the world, commodities, especially agricultural commodities, are the most depressed asset class. Sorry, go ahead. You were asking about my daughters.
Yeah, but I'm glad you mentioned that. So yeah, for your daughters. So if we look forward, and let's say for a moment we get that depression that you think could happen, or whether it's or either way, we get a crushing depression, or we enter into a really highly inflationary regime, and the purchasing power of the currency is crushed. What kind of hope, if any, do you see in this story for those of us like myself and you who have kids? Do you see us eventually, once the system breaks, being able to get back to the type of prosperity we enjoyed for much of the 20th century? Or do you think the future is going to be different going forward, and maybe more constrained in the type of growth we can have because of systemic limitations, like oil getting more expensive or less resources per capita? I'm just curious, is there a hopeful end to the story that you see?
Well, my youngest daughter is 12 years old, so yes, there's hope someday for her. I'm not sure when and where, but throughout history, Adam, yes, we've had at times history shown long periods when prosperity is growing and many people are getting better off. The last few years, decades have been like that, but we've also had long periods in history when things didn't get better for a long time worldwide, certainly in specific countries. I mean, Venezuela used to be extraordinarily rich. Venezuela is extraordinarily catastrophe right now. So yes, we have these gigantic cycles throughout history. I would suspect that the next time we have a problem, I told you it's going to be the worst in my lifetime, but it's the debt overhang unless they just inflate it away, that will ruin a lot of people. But many people will come out of that and make a huge fortune. You know, in the early 20s in Germany, they just inflated it away and ruined a lot of people. On the other hand, there were plenty of smart guys who bought stocks right, who bought property right, and came out of the early 20s in Germany, out of the catastrophe, very, very, very rich. So some people will come out of this, even if it is a gigantic catastrophe. Most of us will not do well. I hope I survive, much less do well. But no, you have to be very little. I urge you to watch Peak Prosperity and figure this out, because there are going to be lots of problems. And next time we have a bear market, it's going to last a long time, or they're going to just destroy a lot of people by printing the money or renouncing the debt, defaulting on the debt. You know, in Russia right now, many people are still collecting their Soviet pensions. Yeah, but the money's worthless. The Russian government said, we're paying you what what the Soviets promised. Well, of course they are, but you're not going very far on your Soviet pension in current rubles, I assure you. But governments do that all the time, Adam. Governments aren't honest. If you trust governments, you're in serious trouble. Next thing you're probably going to do is tell me the Federal Reserve knows how to save the economy. Oh. Well, I told you, what's her name? What's her name? That former Yale PhD says they can do it.
Yeah. So many great points there, Jim. One really big one that you're making, which is, we've said this a lot over the years, but you know, what we see going on really in real time right now, but getting worse, is really a giant transfer of wealth. So to your point, Jim, like, you know, it would happen in Weimar, Germany. Yeah, the currency collapsed, but after it did, there were still the same number of factories, of, you know, acres of arable farmland and whatnot. The thing that changed was just who owned them, right? And so it was the people who were paying attention, who positioned themselves prudently before it all happened. They were the ones that came out of it okay. And that, I think, is the big objective of all curious-minded people watching this program and you know, reading your commentary, Jim, and reading other sites like ours, is trying to figure out, okay, if this is most likely to happen, what steps can I take today to make sure that I have the lowest probability of becoming collateral damage? So I'm really glad that you underscored that. You mentioned, you know,
just quickly, I hate to keep interrupting you, but you know, even in the U.S., I was talking about Germany, but in the 30s, coming out of the horrible depression of the 1930s, there were guys who came out of that very, very rich. I mean, I could name you some names that became wonderfully prominent, successful, rich financial types. They went into the 30s, poor boys from Tennessee or the Bronx or something, and they came out very, very rich. So it can happen for people who are attentive and apply themselves.
Great point. So as we kind of wrap up here, Jim, because I know it's very late your time and you've already given us more than I expected, so thank you so much. But let's just say, you know, I magically appointed you kind of, you know, king of the US, king of the world, whatever. What kind of policies would you be implementing? You know, it's easy to criticize, which we do all the time here, you know, the current people that are leading the system, because I do think they are making very bad decisions and following bad policies. But what type of policies would you like to see implemented?
Well, history is pretty clear that if you run up gigantic debts, it leads to serious problems. We've had many reserve currencies or medium of exchanges in history. None of them have lasted 100 years, 150 years max. So they've all disappeared. And the reason they've disappeared is because they got too deeply in debt. They spent too much money, borrowed too much money, printed too much, and usually got overextended militarily or politically, and they all disappeared. I mean, you probably don't know many people who've got Dutch guilders in their pocket from 200 years ago when it was the world's reserve. And I mean, I don't have to, you can go through history, you'll see it always happens. They get on top, the currency becomes the king, and then they disappear because they get overextended. That's what's happening now with the US. I mean, Adam, if I could go in and say to the US, okay, we're going to stop spending, we're going to stop all this crazy spending, we're going to stop printing money, we're going to balance our budget every year, you know, I would be assassinated. Even if everybody says, he's right, he's right, he's right. But eventually somebody's going to say, this is too much pain. This is too much pain. Maybe he's right, but this is too hard. I don't want to do this anymore. Shoot the guy. So I can tell you what has to be done, and I can tell you what has been done historically. The problem, Adam, is the main lesson of history is people don't learn the lessons of history. You can sit and show them over and over. We have a guy in Washington right now who thinks either he doesn't know history or he knows he's smarter than history. He's much smarter than whatever history says. He doesn't have to pay attention to history, and he can do it his way. Well, I know history's smarter than he is and smarter than all of us. And all of this is going to lead to very serious. Well, what I do, I told you, I balance the budget, blah, blah, blah. Use sound currency, stop spending money. I wouldn't last very long. The world would go into a very, very serious period of decline, a serious decline for a long period of time while we worked off the problems of the last 50, 60, 70 years. Or if there was some miracle way to just go in and say, okay, we start all over. But to do that, Adam, you wipe out a lot of people. If you wipe out all the insurance companies, all the banks, all the endowments, I mean, you wipe out a lot of people. All those people sitting there owning government bonds, for instance, are suddenly wiped out overnight. You don't get your medical insurance payments because the insurance companies are wiped out. So this is not a simple problem. I guess to answer your question, if I were king of all the world and everything, I would resign. That would be my solution. I would resign. Maybe I'd abolish the central banks and then resign. I guess I would abolish the central banks and then I would resign and run for the hills.
All right. I think that's very wise. It's sad when advocating for sound money and living within our means becomes a radical and fatal act. But anyways, makes all the sense in the world. And Jim, I know from having read your work for many years that you are a real student of history. And, I think one of the problems we have right now is it's a problem of human nature, right? Where, the course of history changes, but human nature really doesn't. And to your point, that's why we're sort of forced to repeat the errors of the past. And I think right now, everybody is hoping for that there's some way out of here where we can avoid pain. And I think to your point, our choices really are just, painful or more painful. And we just have to be smart about, which one we're going to pick. And the honest answer is we'll probably delay because we're looking for the magical answer. And then the system will decide for us. Reality will intrude on its own terms rather than ours. And then that's probably going to be more painful than if we had taken some of these more austere and sensible approaches that you've been recommending. But anyways, I want to end just to thank you for your time, for the scope of the insights that you've shared with us. And Jim, if folks are interested in learning more about you and your observations, your work, et cetera, is there a place they can go?
I'm a simple person, Adam. No, I don't have anything to sell. But I just want to say there is an answer, a simple answer, and it's more money today. And I'm afraid we may see more of that kind of. I mean, the British are doing it already. They're not announcing it, but under the table, that's basically what they're doing. And more and more people are saying, this is a very good, intellectually sound, positive answer. Let's do it. And then somebody else is going to say it's an easy answer. And you're going to say, that's it. I need an easy answer. Wonderful. Let's do it. Let's do it. Let's do it. So be careful. You should watch Peak Prosperity.
Jim, a complete and total pleasure having you on. Thank you so much. And would love to have you on again at some point in 2021 to see where we are in the story. Maybe by then all the M&T is already out in the system. We'll see. Boy, if that's true, the market's going to be 30,000 on the S&P. Yeah. Well, if that happens, we will be talking about it with John and Mike, who are coming on next. Jim, thank you so much. Since it's so late your time, we're going to let you hop off and get some sleep. But go home, get some sleep, wake up in the morning, hug your daughters, and we'll look forward to hearing from you in the future. Thank you. Bye-bye. Good to see you, Jim.
Thank you.
All right, folks, as usual, I'm now bringing in the lead partners of New Harbor Financial. This is the financial advisory firm officially endorsed by Peak Prosperity. The lead partners, John Lodra and Mike Preston, join me every week after our guests to comment on where the markets have been, what they've been up to in the past week, and to look through their crystal balls and try to see what might be happening in the near future coming up here. So John, Mike, great to see you guys.
Morning, Adam.
Nice to see you, Adam.
Nice to see you guys too. And yeah, for those watching, John said morning. It is not even crack of dawn my time. Had to get up here in the dark because Jim is in Singapore. And it's about the least conveniently located place on the planet for these types of international Zoom calls. But I'm so glad that Jim was willing to stay up late and make this happen. Guys, we've had some great guests lately, but man, Jim Rogers, huh?
He's a great guest. He's got a storied career and really sound perspective and the humor that can only be welcome these days to talk about such somber realities. So he's someone we followed for a long time, Adam. We really respect him.
Yeah, and folks, this is not by design. Really what we're trying to do with this program is bring on experienced people, whether they're longtime investors like Jim, whether they're market technicians like a Sven Henrik, or somebody who actually works in the plumbing of how markets operate, like a Joe Saluzzi, people that have connected to the Fed, like a Danielle DiMartino Booth. We're really trying to get as broad of a perspective as possible from people across all aspects of the system as to where the optimism should lie and where the pessimism should lie. And sadly, most of our guests are pretty pessimistic at this point, but very interesting and I got to say somewhat validating to see such a storied and decades and decades long experienced successful investor like Jim, largely seeing through the same lens as we, right? I mean, Jim is talking about the markets as being ridiculously overvalued, distorted by all of this, the intervention that the central banks have been guilty of for the past couple of decades. You mentioned his one act of king of the world would be to disband the world's central banks. So certainly he sees them as an evil in this story, not as a positive. And he does look through the same lens as we, is saying, look, there's a real sort of knife edge that the global economy is walking here, and it's either going to fall into, very punishing debt deflation, or we're going to kill the currencies. And neither outcome is really very, pleasant to consider. But, smart, prudent people need to. And then the question just becomes, okay, well, what should we be doing? So we've talked about this a little bit, guys, recently, because we've been seeing more and more guests express concern about entering into an inflationary environment after decades of being in a deflationary one. And commodities keep coming up now again and again, certainly gold and silver, but also increasingly other commodities. And Jim, named a couple, talked about agriculture. Mike, why don't we start with you, and then John, we'll go to you if you want to add on to it. But can you guys just sort of summarize your current outlook and how you're applying that to the current portfolio? I know you guys are still heavily in cash because you're worried about some potential, market corrections in the short term. But despite that, I think your biggest positions still are in commodities, most notably precious metals. Can you confirm that and let us know if you're kind of looking at some of the other commodity spaces as well?
Yeah, Adam, we are still very heavily in precious metal mining shares and bullion as well. A lot of the bullion position that we recommend to clients is, we recommend that they hold that locally and not necessarily, in their accounts. But we're big believers in the commodity space in general, just like Jim has said, they're historically undervalued relative to financial assets and should do very well in the future, particularly if we get inflationary forces. Everyone is enamored with FANG stocks and tech stocks and everything else, but the commodity space looks very attractive. So gold, silver, but also in the larger space, agricultural commodities do look pretty depressed relative to their historical norms, and oil and gas look pretty good as well. Long-term trends in the economy and the fact that energy is a scarce and finite resource should bode well for that sector. If you look at the relative undervaluation of the oil and gas sector compared to the S&P, it too is at a very, very multi-year historic low. So that's a sector that we're looking at potentially dabbling in the near future. What keeps us a little bit more cautious is the fact that the S&P is still near its all-time high at a ridiculous overvaluation and prone to downside surprises. But we're very cautious still. We've got the majority of our assets in treasury bills and cash equivalents. we do expect deflationary forces to start to kick in to some extent, and we want to be opportunistic in the markets to be able to add some exposure there.
Great. So a couple things to what you just said there, Mike. One is, you mentioned you guys are still, holding a lot of cash. We just did our Peak Prosperity Weekend seminar, annual seminar, which was phenomenal, by the way, folks. But I know that you guys ended up having a ton of meetings with a lot of the people that came to the seminar. And I think one of the key things that people, really realizing about the cash position is when you work with a financial advisor, yes, you want them to craft a portfolio strategy and to help your portfolio make money over time. But really, for the type of person that comes to Peak Prosperity, capital preservation is at the top of their mind. And not only do they not want to lose money more than they're willing to gamble for a gain, but what they're looking for in an advisor is not somebody who can just pick sectors to invest in, but can let them know when it's time to kind of take their chips off the table and sit out the game. So if people are having questions about why is New Harbor in cash, it's a huge part of the reason, right? Is you're paying for the wisdom to know when to not be at the poker table. All right. So the other question, Mike, was you were talking about like the oil and gas sector, looking increasingly attractive given its valuations today. But you're worried about the S&P, overall market still being so elevated that I'm putting words in your mouth here, so correct me. But I interpret that as we don't want to get in just yet because we think there could be a market correction that will bring everything down. And so we want to wait for that to happen first and then buy these oil companies at even better valuations. Can you confirm if that's true? And then also just sort of besides that, is there anything else that you would need to see before beginning to invest in this space?
That's somewhat true, Adam. I mean, we might dabble even before a major S&P correction. I mean, the S&P is in a mini correction here over the last week or so. We'll see what happens in the next few weeks, particularly post the election. But the energy space is something less than 2% of the S&P right now, maybe 1.7 or 1.8% last I looked. It's a couple percent, and which is a historic low percentage as compared to the S&P as a whole. And don't quote me exactly on this, but I think it's high at one point was as high as 16, 17%. So, I mean, it's hugely undervalued on that metric and many other metrics relative to the S&P. But because the whole sector, they are comprised of stocks or equities, they are correlated to the S&P. So that has us a little bit concerned because we expect some downside, significant downside in the S&P over the next couple of years. We wouldn't be surprised to see greater than a 50% retracement or decline in the S&P from its high, and probably greater in the next couple of years. But that's not to say that we have to wait for a big drop to do anything. So we might enter relatively soon even, but it would be through some kind of hedge position. We like to use covered calls where we'll buy the stock and we'll sell call options against the position to enter in a very methodical hedge way. So I wouldn't say that we're going to wait for a big drop to do something there. We might very well start a small position hedged relatively soon, just based on how severely undervalued it is.
All right, great. So John, Jim, yet another expert we've had on that has come to the gold conclusion, right? Saying, hey, in this type of environment, you got to get yourself some gold. He's been buying for a long time. Sounds like he took, maybe by the better part of a decade off, but is now an active buyer again. Can you guys just sort of talk about the current gold position in your portfolio?
Yeah, so we, as Mike alluded, we do very much like both gold miners and gold bullion. We tend to suggest folks hold bullion in more physical form than an investment account, whether they vault it somewhere or store it somewhere in a safety deposit box or somewhere else that's more proximate to where they are, because we kind of view that part as an insurance policy, more or less, from some of the monetary mayhem that we've talked about and Jim Rogers just talked about. Now, from an investment standpoint, we really like the gold miners because just thinking about them as stocks and evaluating them as stocks, much like you would evaluate any stock based upon fundamentals, they are tremendously undervalued relative to their norms from a multiple standpoint. They have done remarkable things over the last handful of years, 5 years or so, in cleaning up their balance sheets. So they actually have very attractive free cash flow profiles. And because their bottom line is inordinately impacted in a positive way by rising gold prices, they can have much higher upside potential than the metal itself. And certainly, given all the factors we just talked about with Jim, we do think that precious metal prices are likely to go substantially higher. And consequently, the shares of the mining stocks, we do believe, have a good chance of going considerably higher in multiples of that, frankly. Now, that's not to say they're a non-volatile class. They can be very volatile. In fact, yesterday with the broad market sell-off, the gold miners got hit quite hard. They were down about 6%, looking at some broad indices. Now, we have hedges in place, so for those of our client accounts that we can use options as hedges, those hedges kicked in quite robustly yesterday, and we're in a very good position right now with uncapped upside, but also very robust downside protection should there be follow-through weakness. One other point I'd make, though, just broadly speaking about the inflation-deflation discussion, it's entirely consistent to talk about an inflationary and monetary inflation environment and asset price deflation, and therefore it's not at all, in our view, an imprudent position to have a fairly large, like we do, liquid cash position, because that cash really presents opportunity to take advantage to things like broad stock markets that we expect will, even in an inflationary environment, the first move to inflation in a decided way would likely cause a pretty massive retreat in broad stock market prices. And it's only after that retreat to kind of more reasonable valuations that can historically speaking, the stock market be a good inflation hedge. So that's why we can reconcile holding a very large cash position, even though we might be seeing some inflationary impulses here.
Great point there, John. All right, so just a couple of things to build on what you just said there. So I'm going to put up the URL to the replay videos from our seminar for anybody that's interested in potentially going and purchasing them. Folks, you're going to get over 24 recorded video presentations from past weekend from over 30 different experts that we brought together. I've talked about the whole lineup and everything in the past, so I won't reiterate it here. But amongst some of the great presentations that you'll be able to watch on replay now, one is from Jeff Clark, who he actually gave two presentations. He gave sort of an overall overview of all the different ways to invest in gold and silver. And if you're relatively new to the space, highly recommend you watch that one. But if you own some gold and silver and are looking to get greater exposure, John just talked about New Harbor's approach to investing in the mining stocks in that sector. Jeff has like a 45-minute presentation on how you actually can evaluate a particular mining stock and how you can use that to find potential companies in the space to buy. He even shares some of the companies that he's most excited by right now. So I know that type of information folks have been asking for a long time. It's in that video. There's other great videos there too, many other great videos. One I'm actually probably going to take some clips from and show next week, which is by Grant Williams, who is just one of the best presenters out there in the space. And one point Grant makes about inflation, an inflationary regime, to your point there, John, as he says, really the trick of the game going forward is to be prepared to lose money because it's going to be a very, very difficult investing environment. He just said the objective is to lose less money than everybody else. and it's funny because, as you said, John, when we think about inflation, we just think about prices racing away to the moon, but that's actually not a guarantee. And as all the speakers basically said who talked about this, it's very episodic. And certainly in an inflationary regime, you can have deflation in certain areas. You can have asset price deflation, even while sort of punishing cost of living inflation, makes life continuously miserable for folks. So as sort of Jim was saying earlier, it's a rocky road. You really got to invest in your education and what's going on here. And anyways, folks, the education that was delivered in last weekend's seminar was really, truly epic. It's the best one we've ever done by far, in my opinion. All right, guys. So as we wrap up here, we haven't yet really talked about the action of the week. Mike, why don't I hand it to you, and then John, you can chime in. But we actually have seen some weakness in the past couple of days in the market. We've had 2 days where the S&P was down over 2% both days, Monday and yesterday, I believe. Yesterday was actually a pretty ugly day for the markets. Curious what your guys' observations are going on there. You know, we're coming up to the election, and that's obviously playing a factor here. The stimulus package, the latest one, hasn't been approved. That's playing a factor here. And we're entering into earnings, which is also playing a factor here. So, you know, Mike, what are you seeing so far?
Yeah, just a couple tidbits that we've noticed over the last week. I mean, the S&P is down since we talked last week. It's down about 150 points, or about 4%. And, you know, we're also starting to see, you mentioned earnings season. You know, earnings are coming out and they're looking fantastic, you know, on a comparative basis versus, you know, a year ago or a quarter ago. But we're seeing action that's similar to what happened in 1999, late 99 and 00 in the tech bubble. Earnings are coming out, they're blowing away expectations, and the stocks are just staying there, like stuck in concrete. Like that happened to Microsoft the other day. It reminds me of, you know, being in the business back then, that everything was kind of baked into the cake and there could be no more upside surprises. So things are seeming to be a little bit heavy. And I'd like to remind people that, you know, we talk about the market going up and it feels like it's interminable. It just keeps going up. But it's, if you really step back and look at it, take a look at an S&P chart on a weekly basis, we're pretty much flat on the year right about now as we speak. It doesn't feel like it, but we are. And we're only about 13% above the January 2018 high, which we view as like the first blow off top. We're almost 3 years past that now. And the market's only about 13% past that. It wouldn't take much. That could be wiped out in a week, and all of the gains in the last 3 years could be wiped away in an instant. You know, that happened at the, and there's many examples of that in an overvalued market. At the low in 2009, the market took back all the gains all the way back to 1996. We think that something similar will likely happen here in the next few years in the bear market. In overvalued markets, they seem to stay up forever in an interminable fashion, but then they invariably wipe away everything. All of those gains that were created through stimulus and money printing are repealed at some point. And so that's the game that the Fed is playing now, trying to keep all these plates spinning in the air, you know, like in a Chinese acrobat show. So, bullishness or euphoria remains extremely high. Investors Intelligence bullish advisors 61%. It's as high as the most extreme times in the last 5 years. So we still think that this is a market that's trying to correct off of its. Basically, we think it's a wave 2 correction off of the March 23rd low. It's been a long time. We think the catalyst to pop this giant bubble of all time was likely the coronavirus back in February. It's just that we have to remember that these things happen slowly. And we're starting to see some changes in the market, and we're very attentively paying attention to them.
All right, and you mentioned a wave 2 correction, and this is sort of like an Elliott wave theory, right, where there's sort of 5 waves. And my understanding of Elliott wave theory, which isn't fantastic, but when you have, a wave 2 rebound, right? You have a drop, you have a rebound, that's wave 2. Then the wave 3 drop tends to be substantially larger than the wave 1 drop. Is that correct?
It is larger and faster and more accelerated, generally speaking. This correction of the wave 2 kind of bounce off the March 23rd low has been pretty historically extreme compared to other times. But of course, we've had some extreme stimulus to create it. We've done some videos with you, Adam, where you put up the market psychology chart. And, you know, the wave 2 bounce is also called the return to normal part of the curve, where you have a peak and then a sharp correction that surprises everyone. And then that return to normal is what lulls everyone back to sleep. Now, sitting here today, anyone that bought the dip feels really smart. Anyone that didn't sell in the March correction feels really smart. And, you know, it's created a lot of epic complacency across the board. I mean, this market for so many years has compelled people to buy the dip and has rewarded them for doing so, that there's just no belief that we can actually have a real bear market. This is what the hallmark of a bubble is that nobody believes that market can ever go down again. So we have this epic return to normal move off the March lows that has brought us to this point that we think is very dangerous.
All right, well said, Mike. So John, I'm going to let you have the last word here before we all hop off.
Yeah, as always, Adam, Mike and I always, in our work, in our team, we always go back to the data, and certainly taking a step back and zooming out and looking at the data is always helpful to kind of reorient us and hopefully our folks, our clients, and the folks that hear us where we are in the cycle. Today's headlines are printing a rather massive Q3 GDP number, quarter three GDP number. In fact, record GDP growth in the third quarter, at least on the headlines, right? But even with that in taken into account, the market right now is trading at 160% of GDP. When you think about the stock market, it should ultimately be tethered to the economic activity that those stocks produce. And right now, it's even with that massive beat for the third quarter, is 160% of GDP. That's 14% higher than even the most egregious valuation at the very tippity top of the tech bubble in 2000. And it's actually in the 100th percentile of if you go back over the last 70 years or so. So, you cannot avoid, when you look at the data, to just realize that the stock market is more than priced in lots of rosy numbers, including the headline GDP beat we just got. So, history speaks pretty loudly what that means in terms of future returns, not likely going anywhere, and probably on a path that would see one, if not several, massive declines along the way.
Well, that's great emphasis of what Jim was saying earlier, right? Which is kind of the chronic weakness of the human race is its inability to learn from history. And there's so many people invested in the market today who are telling themselves this time is different, right? Which is probably the three most fatal words in investing. And that's why we have you guys on every week, John, is to just keep us grounded, keep looking at the data, keep looking at the historical perspective. And you just did a great job of sort of summarizing that the data is saying, hey, look, we're at a historic extreme. These things tend to always correct in some shape or form. So don't be riding along this market without a plan B in case things do turn around. So with that, folks, John and Mike, we will see each other next week and see what's happening in these markets. And again, we have an election coming up here soon. So it's going to be very interesting to see what the markets do after that. Mike, you mentioned Microsoft stock not really going anywhere after posting earnings that surprised everybody to the upside. And I've seen some headlines that I think might be accurate, which is just, the market's gotten priced to perfection. So, you can't really improve upon perfection, right? So the only thing you can do is disappoint when expectations are that high. So it's going to be very interesting to see if the election becomes sort of a buy the rumor, sell the news type of event. All right, folks. So as we wrap up here, as we always do, quick housekeeping. First, if you haven't yet, please just take literally 1 second and click the like button here. The number of likes these videos get actually do matter. They determine how widely the videos get shared, and that determines our ability to bring on big name guests like Jim Rogers. Secondly, if you want to find out who we are booking in the future and get sort of insider commentary throughout the week, just subscribe to my Twitter feed. That's @MenloBear. And then lastly, if you have not yet already, and at this point, if you haven't, why not? If you want to get a free, no commitments involved, no cost involved, financial portfolio audit from the team at New Harbor Financial, it is available to you at no charge. There's absolutely no pressure or expectation to work with these guys. They do it as a public service for the Peak Prosperity audience. Just stick around to the end of the video here, and you'll get the instructions on how to do that. And with that said, John and Mike, looking forward to seeing you guys next week.
Thanks, Adam. We'll see you next week.
Thanks, Adam. Have a great week and we'll see you next week.
If you'd like to schedule a consultation with the financial advisors at New Harbor Financial, simply go to greylockpeak.com. These consultations are completely free and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given the latest market outlook. They're willing to do this because they care about protecting people's wealth, and because Peak Prosperity has connected them with so many thoughtful investors just like you over the past decade. Chris and I started doing this because so many people have approached us in frustration and are looking for a solution because they're feeling out of alignment or just downright ridiculed by the standard sort of financial advisors who have been managing their money. You know the type, the kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, don't worry, the market's always going to take care of you. For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing, which is why we strongly believe that today's investors are best served working in partnership with a conscientious professional advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, just as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you aren't, or you're having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. And for those about to ask, yes, there's a business relationship between Peak Prosperity and New Harbor, which we had to put in place to make sure that everything is handled according to SEC regulations. All the details on this are clearly provided on the greylockpeak.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to greylockpeak.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.